Hi everyone. Today I would like to talk to you regarding some financial calculations in terms of purchase of equipments. So, among doctors, especially in the field of ophthalmology, which is highly equipment intensive, we tend to have a lot of machines, lot of equipments. But a lot of times we end up buying equipments which doesn't make a business sense. So it's a very simple calculation which I'd like to show you that how do you go about calculating whether to buy an equipment or not. It's not a big rocket science. It's a very simple Excel calculation. You'll be able to understand it very simply, and we will do it together. So the plan is okay. So let me start. So here you are able to see this small Excel sheet, which with few columns and some figures. So let me recap these figures. The left side of the screen, the red part shows the expenses, and the green part shows the income. So let's take an imaginary equipment, not so imaginary. Let's look at a simple equipment in ophthalmology, which is called as YAG laser. Okay, so should you actually buy a YAG laser, or should you be utilizing the services of third party? This is what we are coming to. So just imagine that you're buying a YAG laser which costs you in the market an approximately a cost of a decent, let's put it at 8 lakhs. The ongoing interest rate for a just basic fixed deposit in a bank is 6%. And let's calculate how long does the machine last. The life of an equipment generally is taken as 5 years to 10 years. So let's keep it at 7 here. So you will see that the total calculated value is coming to around 12 lakhs. Like, had you not bought this equipment and you had taken this 8 lakhs and invested somewhere, so it would have been at least 12 lakhs in 7 years. Understand, this calculation is considering the fact that you have not financed the equipment and you have done an outright purchase. Now, this machine is going to incur you costs. So, costs of around 40,000, we look at AMC CMC cost in this case. So, sum total you have spent around 14 14 lakhs in total. So, that is the thing. Now, let's see how many patients of YAG laser or YAG PI, YAG capsulotomy do you get in a week? So, or how much do you charge? Let's go a bit systematically. So, how much do you charge for a YAG laser? For instance, let's charge 2,500 rupees, and I know that it's on the slightly on the higher side according to the standards, but yes. Now, when you do a YAG laser, there are additional expenses like the dilating drops, the tissues that you use, the staff, the electricity, so just round off to 100. So profit per use is running profit is 2,400 rupees. That's working out. So number of uses per week. Let me say that okay, we have around 4 patients undergoing YAG capsulotomy or YAG PI in a month, in a week. Okay, so that gives you around 16 cases in a month. So 16 cases, we stop at that. There's something called ancillary revenue. Like in some machines, like for example, if you're looking at a visual field, it's a perimeter. So you end up selling some eye drops for glaucoma, which is ancillary revenue generated by the machine. Like if you have an OCT machine, you will be giving anti-VEGF injections. So these are the ancillary revenue. So let's see that after YAG cap you're giving some eye drops, so that generates some amount of revenue. So this revenue comes to around 1,000 rupees per week. Now that gives a total revenue per month of 42,400 and yearly revenue of 5 lakhs. So that gives you a total revenue for life of 35 lakhs 61,600. Now consider the fact that the cost of YAG laser in this is placed as 2,500. Now just see, like a lot of hospitals charge 1,500. Now let's see what happens. So here with 2,500 we are at a profit, net revenue profit of 2 lakh rupees after an end of 7 years. Remember, So let's see, when do you break even? Let's put it as, adjust it as 5 years of life. At 5 years of usage, you are at, so yes, uh, yes, at 5 years of this thing, your profit in the procedure uh, remains as something like 12 lakhs. So this is the thing, that how you work out. So let's put some real figures. Let's reduce it to 1,000 and see what happens. If you're a person who does yak capsulotomy or a yak PI for 1,000 rupees per case, and when you run the same thing in the calculator, it shows you that you are at a net loss at the end of 5 years. You still continue to be in loss. You have not recovered your capital investment till now. So this is the way which I normally recommend. See, this is I'm a practicing ophthalmologist. I am not an accountant. So you should always run this with your accountant, whoever is whom you depend on your financial calculations. So let's look at something else, which is, different scenario. Let's look at, an IOL Master 700, present market rate going to around, these are approximate figures. So present market rate going to around 34 lakhs. 34 lakhs at 6%. The life of the equipment, let's count at 7 years. So the calculated value comes to 51 lakhs. CMC per year is 1,70,000. Total, you are expending 63 lakhs on that machine over a period of 7 years. That is 63 lakhs worth of value. So now, use scenario, average revenue per use. Let's say that you charge a patient for around 2,000 rupees for optical biometry. Your expenses in the terms of the, running cost per use is 100 rupees. Profit per, outright profit is 1,900. Um, just give it a figure of how many cases of, which needs IOL master you would be doing in a week. So as a single practitioner, a small setup would be like 5 cases of multifocals or toric, which will need, in which the patient will be willing to pay for the optical biometry. So that gives to a monthly figure of around 20. Now, in this case, there's a slight difference compared to the YAG laser. Now, because you have an optical biometer available at your place, you tend to do more torics, you tend to do more multifocals. Your confidence level in performing these premium surgeries will definitely increase. That will increase your ancillary revenue, which is not direct revenue. You cannot count it as a direct revenue from this equipment. It's an ancillary revenue. So, so what happens is, if you do around 2 to 3 premium cases, which, just imagine, like, those premium cases is, you are doing those premium cases only because you ended up having an optical biometer. So that will give you an income of around, let's keep it at 50,000 per week, definitely. So that gives you a total revenue for life, uh, per year, per life. When you calculate the entire mathematics, you realize that after 7 years of use, you are at a net profit margin of around, how much it would be, 1.3. That's fantastic. That's a good number. If you reduce it to 5, let's see how it goes. Your profit margins are different. So this is a simple calculator. One of the machines that doesn't, in my small knowledge, my small opinion, if it doesn't match up to this, is what we call as a visual field analyzer. So if you go for a Humphreys visual field analyzer, which was beyond 20 lakhs, but let's put 20 lakhs for the instance, your entire cost of ownership would be 31 lakhs at the end of 5 years. So per use, visual fields is something which is very commonly done and for patients. So the charges for visual fields generally is lower. So when you look at the lower charges for visual fields, it comes around 1,000 rupees, per field. The number of uses, how many uses will do? Let's see, let's put 10 visual field cases per week. That gives you around 40 in a month. Now, the ancillary revenue in these cases are lesser. You don't end up doing a glaucoma surgery so commonly, just like a premium cataract surgery. So, in this, the ancillary revenue would be from the pharma, that is the glaucoma drops that you're dispensing from your pharmacy, and also the glaucoma surgeries and YAC PIs that you might do. So let's put it at a just imaginary figure of 10,000. So here you will realize that you know it in 5 years you have managed, after spending this much amount in expenses, in 5 years the amount of profit that I generated is much lesser. So the thing is, this is a simple calculator which I made to just to show that how an equipment feasibility, because there are a lot of equipments that we end up buying just for the sake of ownership. It's like buying an elephant. It neither gives you any milk, can't you can't use it for routine labor. But yes, it depends on your kind of practice, your setup. Like for instance, my setup is a basic anterior segment setup. My number of OP would be like 20 in a day. So in that, when I run my equipments in this model, what I realized is it doesn't make sense for me to buy an OCT machine. It doesn't make sense for me to buy a visual feeds. One investment which I done is an optical biometer, which is actually serving me well, and it's giving me returns. So my humble request to all of you, that whenever you end up thinking about an equipment, always do a feasibility check whether it's economically feasible. Just because you want to showcase an equipment, it doesn't it doesn't make a business sense. So this is one place where I think that doctors lack, and we need to be more financially aware whether when to buy an equipment and when not to buy an equipment. We should have a proper analysis, cost benefit analysis of these purchases, just like you do a risk benefit analysis for a surgery for a patient. So hope this was helpful for you. You can contact me for, if you want this template, you can contact me. It's just a basic Excel formulas that I used. So that's it. See you later. Thank you.